All right. Today is Tuesday, the 19th of August, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What are we talking about? We're talking about Jackson Hole, Wyoming, and the upcoming speech by Fed Chair Powell. You see, we have a battle coming out in the stock market right now where you have a delusional market that is expecting right now at least 2 rate cuts this year alone. On what basis? What is the emergency? Well, the market looks at the recent jobs data that upset the White House and looks at that as the excuse to begin cutting rates. Even though asset prices at all-time highs, the most speculative assets, the shitcoins, the cryptos at all-time highs, which makes no sense at all. But that's the delusional side, or shall we say the doves. And then we got the hawks. And the hawks are looking at something different. The hawks are looking at the recent PPI data, the producer price inflation data, which was hot. And they look at that as warning that no, the Fed cannot cut rates. If anything, the Fed should be actually hiking rates higher. It seems that the dovish team, which is being right now supported by President Trump and his allies, and the media, and the Wall Streeters, and the oligarchy, and even some Fed dissenters. Then you got Jay Powell standing his ground like a hawk, at least for now, because we know that the original taco is actually Jay Powell. He tackled back in 2018, he tackled back in 2020, and he tackled again in 2022. If he tackles this time around, though, it will be the biggest mistake that Chairman Powell has committed, even a bigger mistake than the transitory mistake, because he's going to be blamed and become responsible for the resurgence in inflation. But I don't know about you. When you think about Jackson Hole, Wyoming, got a lot of bears, a lot of wildlife, a lot of bisons, hawks. It kind of brings the aggression out of you. You become an alpha male when you go to Wyoming. So maybe Mr. Powell is going to transform into Mr. Payne. Some of you might remember 2022, Jackson Hole, Wyoming, Mr. Payne. The market was delusional. Okay, this is the end. We're going to have interest rate cuts now. Then came Mr. Payne, and he brought the market down crashing. Of course, a few months later, he tackled. So we'll see what happens here, but let's just dive into it here, folks, because we got important stuff to talk about. Jay Powell, of course, under a lot of pressure right now, not just from the White House. They resigned Powell, fire Powell, sue Powell, jail Powell, send Powell to El Salvador. It's not just that. He's being pressured right now from the banksters, from the oligarchy, and within the Federal Reserve. Why? Because we have a game where the president wants to replace the Fed chairman. Either he's going to wait, he's going to be forced to wait, to be honest with you. He'd rather fire him right now. But he's looking for a replacement. And this is why we have a lot of whores, really, in Wall Street and the Fed. You see them in CNBC, in Bloomberg, and in the business news media all over the place, trying to say me. Mr. President, me. Pick me. I'm going to be the Fed chair. I'll do whatever you want to do. You want to cut rates by 75 basis points? We'll do it. And like I said, this is now happening within the Fed. So could the pressure be too much for Powell to handle? And he's going to tackle and cut rates comes the month of September. Hold your horses, because right now the dissenters against Jay Powell not really as big as Janet Yellen or Bernanke or Greenspan or Volcker. Certainly Paul Volcker had many enemies in the Fed because they wanted to serve the oligarchy and the banksters. He stood against their way by hiking rates, and he effectively defeated inflation. And we know that Jay Powell goes back in history and he glorifies and he studies Paul Volcker. He wants to be known as Paul Volcker of the 21st century. But you can't do that if you tackle. You can't do that if you cut rates. You gotta stay strong. And to be honest with you, right now, as I said before, the law of diminishing returns. That's what's facing Jay Powell right now. The longer he stays in the position, the more losses he's gonna suffer. If you cut, you're going to be blamed for inflation, because inflation will make a comeback. It'll be a policy error. And if you don't cut, you'll be subject to blame again by the White House for not cutting rates. Any problems that happens in the economy, blame it on Powell. So I suggested recently that it is in the interest of Jay Powell to resign before the September meeting. Now, there is a delusional camp that says, comes Jackson Hole's speech this Friday, Jay Powell is going to cut rates. Disagree. Zero chance of that happening. Now, there is another camp that says, no, what Jay Powell is going to say is he's going to keep his options open and he's not going to commit to cutting rates in September. He wants to be data dependent. And that's what impacted the market today negatively. A lot of folks are saying, okay, we're pricing in 3 rate cuts, comes the PPI. Now we're down to 2. And with the PPI data, I don't think that Powell is going to do it. Maybe that's what he's going to do. So we have to de-risk, dump stocks, especially the winners, the high flyers, as you see in today's session. So we're going to talk about that in a minute. But the other element of surprise in Jackson Hole could be if Jay Powell resigns. That's a possibility, and he could do it. It's going to be in his best interest to do it and say, you know what, folks, thank you so much. The show's over. You take it, Mr. Trump. Do whatever you want to do. You want to cut rates by 1,000,000 basis points, you do it. You assume the responsibility. I'm out of here. You want to manipulate the jobs data and have your stooge cooking the data? Go ahead. You want to cook the inflation data? Go ahead. You want to cook the interest rates? Go ahead. Let's do a Frankenstein experiment in the economy. See what's going to happen. But I'm not going to be involved in it. I think that would be the best outcome for Powell. But we'll see what happens. Of course, all eyes on Jackson Hole. But I want to share with you my frustration when I listen and watch the business news media these days. But you watch CNBC, it's a filthy channel either way. I mean, Jeff Bezos is going to buy it, so what do you expect? It's going to get from bad to worse. But last year, when we had the Biden presidency, you had the liberal/Democratic analysts like Steve Leisman. And he was saying that the economy is great, the stock market is beautiful, there is no inflation, the consumer is doing better than ever before. And the conservatives in that channel, like Rick Santelli and like Joe in the morning, they were saying, no, there's inflation pressure, there's a bubble going on in the stock market, this is not a good economy. And now it's 180. Now the camp that supports Trump says, yeah, the stock market is great, the economy is doing pretty good, tariffs are not inflationary, everything is beautiful. And you have the other camp like Steve Leisman saying, oh, no, we have all kind of problems in the economy right now. And this is why in this channel, we remain consistent. We stick to the facts and the data, and we don't give you the hypocrisy, the political bullshit that you see in CNBC and the rest. But among the hypocrisy, which is really stunning to me, is this kiss-ass initiative that a lot of folks are doing just to win the Fed chairmanship as Trump begins to look for a new Fed chair. Among those who are kissing ass right now is one of my favorite economists, Mohamed El-Arian. And listen to what he said today, because I can't believe that this guy slipped this bad. Take a look.
Thanks for having me.
You think you know what he might do this week or say?
I don't. I think he will be inclined to maintain maximum policy optionality, and that's not what the White House wants to hear. That's not what many people in the market want to hear. He's also going to be pushed on the labor market. That's the topic of the symposium. And then finally, and something that we don't talk enough about, is the monetary framework. This is when he unveils the monetary framework.
Do you think that it would be a mistake to maintain this optionality? Why shouldn't he do that? We just came off a week in which we got some, inflation data that was at least a little bit hot, sticky if nothing else. How's he wrong?
So now we're starting to see the problem with excessive data dependency. He got two different inflation numbers. He got softer than expected CPI. He got hotter than expected PPI. He got a UMISH survey that is flashing yellow. If you simply look at data, by the time you get a clear indication of what you should have done a few months ago, it's too late. And that's the problem with this data dependency.
So again, he has a valid criticism of saying that the Fed is looking backward, not having a strategy, an outlook, which has been my criticism against Jay Powell for a long time. He just looks at the data and then reacts. He does not have a vision. And that causes a lot of market volatility and a lot of uncertainty in the economy. But at the end of the day, what are you going to base your vision on? What are you going to base your outlook on as the Fed? Because the data is not reliable to begin with. And we know that we have stagflation in the economy. So if Mohamed El-Arian is saying that the Fed needs to have an outlook, and that outlook means that the economy is going to weaken as time passes, which is inevitable, and that means they should be cutting rates right now to prevent that recession. What about the inflation risk, Mohamed? Because that risk has not been eliminated yet. Matter of fact, that risk is being amplified with the tariff policy, as we begin to see right now earnings after earnings after earnings, from Procter & Gamble to John Deere to today Home Depot's earnings, all warning that the tariffs will cause an increase in pricing. Period. Full stop. What do you do with that, Mohamed? Well, he got a suggestion that, inflation doesn't matter because did we say 2% is the goal? Let's move that to 3%. Take a look.
Okay, so they should cut in September.
They should have cut in July.
Okay, but they didn't. And July's in the rearview now. They should cut in September.
They should absolutely cut in September.
By how much?
I would cut by 25. I wouldn't be super surprised if we get a repeat of last year. Remember last year, they absolutely didn't want to cut in July, and they cut 50 in September. If you ask me, that's a 20% probability. If we get a bad labor report before the September meeting, they'll cut by 50.
But what if he wants just more optionality for another inflation report?
Then we risk being late. And what we have to realize, and I know this is the least popular thing that I can say, is that we have sticky inflation at 2.5% to 3%. As long as inflationary expectations are anchored, we can live with this slightly higher inflation because the structural side of the economy is changing.
So again, why move the goalpost? You got to remember that Harvard did a study, and if we use the inflation metrics we used back in the 70s, the inflation rate right now would be around 6 to 8%. So we're already manipulating the inflation data and the calculation to begin with. You want to manipulate that even more by moving the goal higher? You got to remember, again, this is absolute lunacy because you got to remember back in 2020-21, what did Jay Powell do? The lethal mistake of transitory. And how did that happen? He said that we need to rescue the economy. We need to anchor inflation expectations higher. Well, guess what? When he did that, inflation went out of control. So when Mohammed says that we have to move the post from 2% to maybe 2.5% or 3%, what you're going to do is you're going to get 5% plus worth of inflation because you've anchored expectations higher. You told everybody that it's okay to have higher inflation. You're going to see the price gouging. You're going to see all of these phenomena that we've seen before. The other thing is, if your case of cutting rates is based on weakness in the jobs data, how do you know if the weakness in the jobs numbers, the jobs market is legitimate or not? What if it is a byproduct of AI? I mean, Zero Hedge shared this chart from Goldman Sachs today. Really interesting. Look at the difference between data center construction, that's in dark blue. And then in light blue, you have construction of offices. And you can see the trend. Offices down, data centers up. So what if the weakness in the jobs market is coming because of AI? How does cutting rates by 25 basis points or 50 basis points is going to remedy that? It ain't going to stop AI. It ain't going to stop the big corporations from adapting AI to get rid of employees. This has been the goal from the get-go. It's not legitimate ground for the Fed to cut rates. Furthermore, in this channel, and I've been saying this for a while, you gotta understand the concept of the duality of the risk. What you're looking at right now, the higher the bar goes, the higher the risk, the lower the risk. So right now, the status quo that we're in right now, both risks are kind of elevated from where they're supposed to. The duality of the risk, inflation and a recession. When you have both of them, like this, you have a stagflation phenomenon. And the problem when you get to this stage is, if you want to tackle recession, as Mohammed El-Arian is suggesting and many others are saying the same, and you cut interest rates to remedy that recession, that's going to come at the expense of inflation heading higher. Likewise, if you tackle the inflation risk by increasing interest rates, you're going to exacerbate the odds for a recession. So this is the worst outcome. We've been warning about this, that the Fed has to induce a recession in the economy before we get to the stagflation phenomenon. But the Fed thought that they can have their cake and eat it too, that they can begin to cut interest rates, ease the policy, and inflation would be dead. When we all know that the natural remedy for inflation is a recession. Once you have inflation in the economy, and it's not transitory, we have some cases of transitory inflation, toilet paper and COVID, for example. But those don't last too long. But when you have systemic inflation, monetary inflation, blowing up the money supply and the deficit, the only remedy for that is recession. And the sooner you accept that, the better. Of course, the Fed said, nope, we're God. We can reduce inflation and keep the stock market hot, and we can keep the economy hot, and there's not going to be any inflation, and we're not going to have any recession. Well, here we are. Got to face the music. Furthermore, here's probably the most solid evidence and proof that the Federal Reserve should not be cutting rates at all. Not even thinking about cutting rates. What do people like Mohammed El-Arian say about this? What you're looking at right now is the price index for the ISM services, meaning pricing in the services sector of the economy. And we are pretty much dominated by the service sector. But look at what's going on here. Let's go back to the problem of transitory. What was the highest reading in the ISM price index for services before COVID? It was right around 2017 where I'm pointing right now. The moment you begin to see readings above that number, that's when the Fed needs to take the initiative, because this is one of the greatest leading indicators for inflation. And the warning sign came in February 2021. The Fed, of course, ignored it, kept saying transitory until 22 before they did something. And look at where we are right now. We're having readings just as close as February 21, when we got an inflation problem in the economy. So this is a leading warning sign that inflation is heating up, and it will be absolute lunacy, absolute madness to cut rates right now. And if that was not enough, listen, Kevin O'Leary, he makes the case of why the hell would we cut rates when you have the shit coins and all of these assets at all-time highs? Take a look.
And we've got almost full employment. And as you said, if you drop the Fed rates, you're going to spike these asset classes, including the risky ones, even higher. For what purpose? What are we trying to fix right now? So if I'm Powell, I'm saying, wait a second, all cylinders are firing. We don't have a problem here. Now, if there's going to be a cut at all, max, it's 25 basis points, but I am not investing on that basis. I think you may get a surprise, and he'll just say, look, the data's coming in hot. We're not cutting, and I know I'm getting whacked, so I'm not worried about it. Deal with it.
Anyhow, with the concern that Jay Powell might be a little bit hawkish and he's not going to buy the case for interest rate cuts in September, comes the Jackson Hole meeting. We've seen the market trading negatively today. On top of that, we're beginning to question this whole AI bubble. Even Snake Sam Altman is now admitting that we have an AI bubble, he says, forming. I say it's blowing up right now. Spending with no concern at all, just spend and then ask questions later, which will be, by the way, the nail in the coffin for a lot of these mega cap technology companies when they realize that they spent all of these billions of dollars on initiatives that are not going to produce anything really. That the Chinese are beating their ass, doing AI with a lot more efficiency. But anyhow, this was also part of the concern today why the market sold off, at least the big names, the technology names, and the semiconductor names, because we also got another report. You got to remember, NVIDIA, we talked about the NVIDIA affair and how the Trump administration said, yeah, sure, we can sell the NVIDIA chips to China so long as I get 15%. And we sell the outdated H20 chips. I don't think they're outdated, by the way, but that's the case that the White House outlaid. Well, now we get a report that no. NVIDIA is now going to develop a twin chip to their Blackwell. This is the latest version, the top of the tier. Cream of the crop, if you may. And what NVIDIA is doing is just downgrading these chips a little bit to bypass the regulations and the restrictions for exports to China. And the Chinese will take these chips and tweak them a little bit, and then they're going to have the same capacity and capability of the actual Blackwell chip. In other words, NVIDIA doesn't really care about national security, about who's going to win in AI, about even NVIDIA itself in the future, whether it's going to be disrupted by Huawei and other Chinese companies. All what NVIDIA cares about right now, when I say NVIDIA, it's really Jensen Huang. All what he cares about right now is money. And he knows if there's any restriction of selling chips to China, NVIDIA's stock is going to crash right away. And NVIDIA's stock is right now worth almost $5 trillion. It's the highest weighting in the S&P 500. Imagine having a $5 trillion blow up in the market. The market is going to crash. Of course, Jensen Huang is not going to be able to sell shares and buy mansions, an island, and tigers, doomsday bunkers. So the source of concern from this piece of news is, what would the White House do? Because the White House said no Blackwell chips to China. H20 okay, but not the Blackwell. So how would we see the reaction of the White House? That's going to be really interesting. So you see today, the market decided, you know what? We need to trim some of these gains. We need to book profits and de-risk. So you saw, this is a list that I watched for many stocks, just a sample here. The biggest decliners of the day happen to be the high momentum names, the retail investor names that have been flying high regardless of anything really, because it became a gambling, a casino since April. So you see names like QuantumScape, like Palantir down about 10% today. Names like MicroStrategy, Peloton, HIMS, AppLovin, Coinbase, Reddit, all of these high flyers are being dumped right now because what if the Fed doesn't cut rates? Then you cannot justify the recent rally in these names. You have other names, a little bit of a higher quality like KTOS, but also was a high flyer, so it needed to be sold today for profit taking. What kind of stocks are working in today's session? You look at the gainers. How about Intel? We talked about this a few videos ago that my bet is the White House wants a piece of Intel, and couple of days later, we got the news that Trump wants a 10% out of Intel. And now he has his buddy in SoftBank buying 20%. So we see Intel flying high. So buying the stock was the correct choice. We also see names such as Wynn Resorts, NEO, MLCO. We see names like TCOM, a Chinese company. All of these are Chinese companies. And this is why this year we've been concentrating on China in my portfolio, because these names continue to move higher. And if you're looking for value and the possibility for growth, it is in China, not here. So this is why we see these Chinese names moving higher. We see some of the laggards, some of the dividend-paying names, the defensive stocks, as I'll show you in the heat map in a second. Those names tended to outperform today, so it was, at the end of the day, a risk-on to risk-off rotation based on the news that we got from Sam Altman, from NVIDIA, that, hey, there are questions here about the AI bubble. But most importantly, of course, is Jackson Hole and Jay Powell. But if he throws cold water with interest rate cuts, that's what impacted the market negatively today. Now let's segue to the morning brief and do a little bit of a strategy review, because today you can pause this and read it for your own. But I talked about, I want to look for names that can bypass the tariff. Meaning, they can do price gouging because of the tariff and get away with it. So I noticed that stocks like General Motors, for example, GM, it's supposed to be a victim of the trade war, but it's trading pretty good if you look at the chart. So it caught my eye that Toyota could do the same, and Toyota been lagging the Japanese stock market. So why not grab some shares at Toyota and set a stop loss at 190 just in case it goes down? So that's what I did today. Another company is Zinnia, ZGN, luxury fabrics. The customer who buys these kind of suits and fabrics, not really price sensitive. If they jack up the price, they're still going to pay. So they can get away with some price gouging. This is the chart that I gave you for TM Toyota Motors daily chart. It looks like an inverse head and shoulder. Today we closed positive, just a tick, nothing major really. So we'll see how this is going to play out. And here's the chart for ZGN, weekly chart. You see a similar inverse head and shoulder pattern. And if I'm right about this, it should be working out and we see higher prices to come. But if I'm wrong, I'm going to cut my loss at 760. If we trade below that number, okay, we're violating the inverse and shoulder pattern. Nice try, but goodbye. We also revisit the morning brief from yesterday. And again, in a nutshell, I said that if you look at the E-mini futures for the S&P, I think we have a correction coming from a rising wedge pattern. So we went with the weekly 640, 635 put debit spread in the SPY, and we paid about $1 for those. And right now we're up about 60%. We'll see what happens, but if there is more de-risking before Jackson Hole, my expectations is the trade will be even more profitable. So we'll see what happens and give you the updates, of course, on a daily basis on my Discord live streams. You know the deal. But let's add more color to this conversation, folks, by revisiting the market activities today, beginning with the closing of the indices. And here we go. I'm leaving all the indices together right here because you know that the Dow Jones is a reflection of the risk off rotation, the value stocks outperforming. When you see the Dow outperforming the NASDAQ, you know that we have sort of a value rotation. And the Dow was just a tick positive today. The NASDAQ, on the other hand, was leading the way to the downside, down about 314.82 points, or a loss of about 1.5%. So the NASDAQ is saying, hey, a lot of the managers, a lot of the investors, the traders are saying, let's take some profits, let's de-risk, because who the hell knows what's going to happen. Of course, the S&P is another technology ETF, so live and die by NVIDIA, and it goes down with the NASDAQ. The Russell 2000 small caps more impacted by interest rate expectations. And recently we've seen a big pop in the Russell 2000 after the jobs data, because everybody anticipated that the Federal Reserve is going to cut rates. But now as we begin to face the music and we account for the PPI data, maybe Jackson Hole, Mr. Payne Powell, not going to cut rates. And this is why we see those expectations of interest rate cuts coming down, with it the Russell 2000. How about the sectors? In a day where we have a defensive rotation, we see that the laggards, the losers, led by technology, comm services, energy, cyclicals, all down for the day. What's moving up though? The defensive sectors, dividend paying, good valuations in real estate, in consumer defensives, in utilities, and healthcare. And expand on that when we look at the heat map, but how about the breadth? The NYC was close to 50-50, a touch positive, 54% advancing, 45% declining, so the market maker exercised maximum pain when it came to the NYSE, meaning that the majority of the calls and the puts expired worthless. In the NASDAQ, though, the market maker had to squeeze a little to the downside and assume a little bit of loss. So we see 31% of the volume was advancing, 65% was declining, and this is an evidence that the market maker was not expecting a decline, let's say below 642 today in the SPY, but it happened. So they had to sell the SPY and the NASDAQ and assume a little bit of a loss. Now we look at the heat map. Here it is. What's in the red? The high flyers, the momentum names, the technology names. So you have NVIDIA down about 3.5, AVGO down about 3.5, Broadcom, AMD down over 5.5, Microsoft, Oracle, Palantir down about 10. You have Google, Meta, Amazon, Tesla, Netflix, AppLovin, the banks, the Robinhoods of the world in financials, the Coinbases of the world also in financials, the data center plays in utilities such as CEG, VST, Vestra, and in industrials, VRT, Vertiv. All of these are data center plays, all down for the day. De-risking, take the money out, take the profits. No need to be cute here when you have uncertainty coming from Jackson Hole. Among the names that got sold, gold miners. You see gold miners and basic materials down for the day. Why did that happen? Because if Jay Powell is hawkish, he's not going to cut interest rates in September, then the dollar is going to rebound higher. If that is the case, not going to be good for commodities, not going to be good for gold specifically. So we see that investors today rotated toward value, dividend-paying stocks. So you see in financials, you got names like Berkshire Hathaway, the insurance names doing pretty good. You look at healthcare, I'm still a fan of the healthcare sector, although I'm not a fan of the ETFs because they're heavily weighted by UNH. I don't like UNH, told you that in the beginning of the year. But you look at the big pharma names doing pretty good. You look, with the exception, of course, of NVO and Lilly. Don't want to get engaged in that game because the Ozempic bubble is popping. But you look at some of the names in diagnostics like Thermo Fisher, which we've seen some highly unusual activities of buying the 500 calls, and we see the name surging higher since then. If you look at medical devices, we have Stryker, SYK, offers a lot of value. You have ABT Abbott, and you have MDT Medtronic, which was down today because of earnings, but it could be a buying opportunity. You see again the value names in industrials, such as the trash names, waste management going higher. The railroads, that's based on speculation that we're going to see M&A, or we're going to see some mergers happening in that sector. We see real estate, of course. We have interest rate in the long end of the yield curve. That's the caveat, by the way. In this defensive rotation that we've seen today, does real estate make sense? Do home builders make sense? I'm not sure about that, because what if Jay Powell comes out hawkish? We see interest rates, meaning yields on the short and the long end of the yield curve, moving higher. If that happens, then you see real estate down, you'll see the home builders down. So these two are not my favorite rotations into defensives today. Utilities, the classic utilities like Dominion, like Duke Energy, those are okay. We own some of them. The defensives into staples like Philip Morris, Mondelez, PepsiCo, Procter & Gamble, Coke, these are okay, but you got to be selective. You got to look at earnings and pick the highest quality of those companies that are going to be resilient to inflation, to cost pressures from the tariff, and they have the ability to pass the extra cost down to the end consumer. In cyclicals, you see Home Depot, Lowe's going higher because of Home Depot's earnings today. We look at O'Reilly, AutoZone, AZO, these are defensives within cyclicals. You got McDonald's, another name that does pretty good when we have defensive rotations. In comm services, lastly, you got the classic Verizon, T-Mobile, AT&T, Comcast. Those do pretty good in a day like today. Be honest with you, if you want to see a defensive rotation, I'm going to pick some of the healthcare names, maybe some utilities for now, but that's about it. I'm not going to be cute and buy real estate or home builders. I think we have a lot of uncertainty that interest rates could go higher in the aftermath of the Jackson Hole meeting. Moving on to commodities, we see red across the board. We got the meeting with Putin in Russia. We got the meeting with Zelensky in D.C. And so far, we have no deal. But we see commodities going down either way. We see nat gas down about 4.5%, palladium, which Russia is a big producer, down. We see wheat down over 5%. Why? Because expectations that the dollar might pop higher in the aftermath of the Jackson Hole speech. You see coffee futures surging higher, and we talked about this a week ago, that coffee is a buy because of the Brazilian tariff. So we see coffee up about 4.5%. Unbelievable surge in the price of coffee recently. Now we see soybeans down. And today we got the news that U.S. soybean farmers are now urging Trump, you got to make a deal, man. You got to ask the Chinese, the Japanese, whatever deals you're making. Don't give me the fugazi numbers of, Japan is going to invest $1 trillion. That's not going to happen. Give me something tangible. Ask Japan to buy some of our products, to buy some of our agricultural products. Ask China to buy some wheat. Ask China to buy some soybeans. I mean, soybean prices are going down even though we have a surgence in the soy boy population. Why? Because we have no trade deals in reality. And the other reality is we're screwing up a lot of our markets. So, for example, we're driving China to buy grains from Brazil now, being hostile to Brazil, being hostile to China. And now we're driving the Indians into the arms of China. India is now saying, we're not going to buy U.S. wheat, we're not going to buy U.S. soybeans, we're not going to buy U.S. anything. We're going to buy this stuff from China and Russia. You got to remember, India and China are not the best friends. If anything, they're kind of enemies. But now we get the piece of news that China says India is a partner, not a rival. And you see that the foreign ministers, China and India, met. Is it really in our interest to push India into the arms of China? Or is it in our interest to strike deals with India with China, with Japan, to buy some wheat, some soybeans, and corn from U.S. farmers? I think the answer is clear, but we have a chaotic policy right now. You're going to hear more on that when we talk. We have a bonus video if you happen to be a member in the channel. We're going to cover earnings from Deere and Home Depot and cover the tariff impact, but you're going to see unbelievable stuff when we talk about Deere's earnings. So stay tuned for that one. Moving on to the big casino, the options market, what do we have here? The volume is a little bit on the higher side, but it could be because of de-risking, buying some puts before the Jackson Hole meeting. Anything that stands out, we see volatility beginning to move higher in NVIDIA, so we could see more declines to come because the IV rank is moving higher, but it's not close to 100 or 90 or 80, the elevated levels where we say, okay, we have a top. So we could see more declines to come in NVIDIA. Same thing with Palantir, down about 10% today, but the IV rank is about 23%, so we could see more declines to come in Palantir. Intel went down a little bit, cooled off the high volatility. Now it moved up by about 7%, but you see the IV percentile at 63%. That could go up to 90, so we could see more upside to come in Intel. Now, what is the difference, by the way, between IV percentile and IV rank? IV percentile is the measure of time. IV rank is measure of actual volatility. So usually the IV rank is a better indicator to pick bottoms and corrections when we get, let's say, 100%, 90%, then you're close to a bottom. You want to close your puts. The IV percentile works better when you're trading calls. For example, you get the open door technology. The IV percentile yesterday was almost 100%. So no wonder why we pulled back today. So we get the IV percentile elevated, you're probably reaching close to a short-term top at least. Keep that in mind. Now, let's look at the options expiration all the way till Friday. We want to study the gamma right here. And you can see that we have a call wall at 650. That's out of the way right now. It's going to take a miracle for us to go to 650 again. But look at the gamma flip. The point of the gamma flip is 642.80 on the SPY. Today we closed a touch below 640, which is, by the way, the put wall too. What does that mean? The risk for an inverse gamma squeeze is highly likely. And if that is the case, now we have to look at the gamma exposure. The biggest gamma exposure for the puts, the column in yellow, is 640. We closed below. If we see more selling to show up tomorrow, then we're going to visit the next highest put gamma exposure, and that's going to be at 635. Again, these numbers change every day because every day we have volume changes in calls and puts. But right now, this is what it looks like. Let's move on to the unusual activities. How about we begin with the bullish ones? ATP, AppLovin. They bought the 430 calls. Stock trading at about 410 right now. The expiration date is September 19, spending about $1.25 million. This is what the trade looks like. So they're aiming for 490 or above by September 19th. I don't know. What do you think? I think this chart is looking weaker here, and it's pulling back, and I think it might pull back even more, so I'm not a fan of this trade right here. How about some of the unusual ones, maybe insider kind of trades? DNTH, another speculative biotech play. Somebody bought the 25 calls. The expiration date is October 17th, 2025, spending about a little over $1.25 million. You look at this chart right here. This trade, by the way, was initiated yesterday, not today. And today we see a big pop in the stock, and we're above the 200 days moving average. We have higher lows, so maybe they know something that you and I don't when that report comes out. But as in any biotech play, they can have insider information that by a certain date, we're going to have a trial result or some sort of an announcement. But they don't know if it's going to be good or bad. So it could be a crash once earnings come out, as we've seen in Vikings Therapeutics today. Just keep that in mind. It's worth playing it with a little bit of money, speculating on a pop, but you don't want to spend too much. Here's another one for you that's highly unusual, also biotech play, MLTX, Moon Lake Immunotherapeutics, whatever the hell that is. Probably a cover-up for an Epstein operation, but anyways, in this case, they're doing a bull call spread by buying the 60 calls, and they sold the 80 calls for the expiration date of September 19th, 2025, spending about $800,000. You look at the chart, I'm not a fan of this one. Let's do the bearish activities. How about CRDO, bear call spread? Meaning that you're selling a call and you're buying a higher call as your protection. You're basically betting that from this point on, the stock is heading down, not up, so you want to collect some premium. In this case, they sold the 125 calls, expiration date September 19. They bought their hedge, their stop loss, at the 140 calls, also September 19th, all in all receiving a premium of a little over $1.25 million. So this is what it looks like. They sold the 125. In case it goes higher, they bought the stop loss at 140. Right now, it looks to me that the chart is heading down, not up, so I think they have the right call here. Then we got a really interesting one. A long put on the 2-year T-note futures. What does that mean? If you're buying puts on the T-notes for the 2-year, you're betting that the 2-year yield will go higher. Why would the 2-year yield go higher? Because interest rate expectations are dampened. How the hell would that happen? Jackson Hole. So here somebody bought the 104 puts. The expiration date is September 26, 2025, spending about $2 million, betting on higher interest rates. Hawkish Powell comes Jackson Hole. The last one I got for you for the XLK, this is the technology ETF. It covers the big cap technology stocks, which could be a hedge, by the way, but even if you want to bet against them, you don't want to pick the individual names one by one. You can just short the XLK. And in this case, somebody bought the 250 puts for the expiration date December 19, 2025. Right now, the XLK is trading at about 263-ish. All in all, spending about $1 million. Let's do some charts. We begin with the E-mini futures 2-hours chart for the S&P 500. We talked about support number 1. It was 6,453.25. That's broken now. We see a little bit of a mini support showing up right here. If we zoom in a little bit more, you see the reactions that we got right around here. Let's say 6,420, which we're trying to reclaim at the moment. And if you zoom out, you'll see that we have in the hourly 2 hours, this chart, we have a little bit of oversold conditions. So what I would see, maybe a rebound overnight, just a little bit to cool off these oversold readings, and then maybe head down later on when we open the opening bell here in the US. We see another revisit, and if we do that, we have support number 2 be 6,390. You got to remember, if we zoom out, so long as we're trading above 6,350, we have the bull right here. What does that mean? It means that the dips will be bought. If we break this support, 6,350, then we enter the gray zone between the bull and the bear, which is going to be a decision-making zone. Now, if we decide to go down and break 6,240 where the bear is, and we can see support right here, and again right here, and again right here. So if we end up going down there at some point, and we break that, then okay, we have a market that's probably going to begin to deteriorate really fast. And we have a bearish phase resuming in the market. But right now, one step at a time, folks. We'll take it one support at a time. And for now, 6,420 is the number. If we rebound a little bit, then break it again, I would say the assumption is probably going to be at least 6,400 coming out really soon. And by really soon, I mean as soon as tomorrow. How about the Russell 2000, RTY, mini futures? What do we see here? Still looking pretty good, by the way. Still the possibility of maybe a bull flag breakout. But that depends, of course, on interest rate expectations. If the market begins to push the 2-year yield higher, anticipating a hawkish pound in Jackson Hole, I think that the IWM will begin to lose a lot of steam and head down and revisit this conjunction right here of the 50 moving average in blue and the 200 in orange. The Dixie, the dollar, will be impacted by what Jackson Hole Jerome Powell says. And right now we have a series of higher lows. Yes, we went down after the bad data that we got, but now we're coming back up. So could J. Powell firm up the dollar even more, get us back to 100 again? That's a possibility. What does that mean? It means that the old man gold will suffer a little bit. It might go down to 3,300, even 3,250. That's a possibility. We're not going to freak out until we get to that point and below. But right now, it could cause a pullback in gold. How do you play a hedge against your gold position if you assume that the dollar is going to go higher based on the hawkish pound? How about you go with some puts on the GDX, the gold miners? So here, look at the GDX failure to play the bull flag with this candle right here. And we have a pretty wide gap between the 50 moving average and the current price. So we could go down and revisit that 50 moving average. So this could be a good hedge if you assume that the dollar is going to go higher and gold will begin to retreat a little bit more. What about crude oil? Still the possibility of inverse and shoulder, but right now trading below the 200 days moving average, not looking pretty good. So we leave oil alone for the moment. Yes, there were some hopes that after the Russia meeting in Alaska, we might see crude oil moving higher, but it didn't. And right now, crude oil is waiting on what the Fed is going to do. I think the commodities, all in all, are worried about how the dollar is going to behave and what the Federal Reserve interest rate policy would look like, more than the geopolitics. So I think you'll see a bigger impact once we get closer to Jackson Hole. But right now, below the 200, I'm not interested. Give me above, and then we're going to talk. Another chart that could be impacted by interest rates as they fluctuate in anticipation of the Jackson Hole speech, XHB. The XHB does pretty good when we see the 30-year yield moving down. And today we see see it moving down a little bit. So we go back to the XHB, doing pretty good, but are we seeing here, if we zoom in, are we seeing some sort of closing the gap, having sort of a lower high, and then we head down in maybe a maverick kind of top? I think that could be the case. If we see the long end of the yield curve moving higher, XHB will be sold. Right now, the money managers, at least the ones I talk to, they're buying all in the home builders that we're going to see interest rate cuts because the president wants them, not because we have a legitimate reason. And that's going to be good for the home builders. And we see a little bit of a surge, but I think they went a little bit ahead of themselves, at least in the short run right now. And we're going to see a correction in the XHB. How about Apple? Apple is the laggard, mind you, of the big caps, so it is performing better than the rest of the big caps today. And right now, so long as we're above the 200 days moving average, we're okay. We have a bull flag pattern, and that could play out. Let's find the bull flag pattern. There we go. But we want it green, of course. So that's your bullish flag. So right now, that's the assumption, unless we begin to break the body, the pole of the flag right here. And the high would be 231. So when you begin to break the body of the pole, let's say you head to 230 or below, and we have a daily closing at 230 or below, then the bull flag possibility goes kaput. And we might talk about revisiting the 200. But right now, Apple looks a lot better than the rest of the big caps. When we look at NVIDIA 2 hours chart, what do we see here? We have, again, a top right here, resistance again, third time, couldn't make it above that 185-ish resistance zone. So we see the sellers, the profit bookers now showing up. I think there is more where that came from, and if that is the case, we might actually revisit the lows right around here at 174, 172, and then maybe break it a little bit more, and maybe settle around here at this support around 165, and then leave it to earnings, and that's going to be out on Wednesday the 27th. The souffle Tesla, what do we do here? Again, there's the possibility of a gigantic bull flag, and we could move higher, but right now we're trading below the important resistance of 333. My assumption, you see here we have support right around here, another one right around here. Again today, let's call it 328.5. If we begin to break below that number, then we have to revisit the next support around this consolidation zone. I would actually roll it down to 313, because once you begin to break down in Tesla, options market, gamma squeezes, we could see exaggeration of the moves, and we pass this support right here, and we settle at 313. But one step at a time, you got to break that triple support right here before we see that move happening. And lastly, BTC, good leading indicator, by the way, about the stock market. And we talked about this being a false breakout. How could you break out without knowing what the dollar is going to do? How could you break out without knowing what the PPI do? So there was a little bit of FOMO of chasing, ETH went higher, BTC didn't. So maybe there's a catch-up trade in BTC. Didn't work out. A lot of folks here got hit. They had to sell right away. So we see a bearish engulfing candle, and the selling continues. And we've now lost the 50 days moving average. We got support, so this is what I'm highlighting right here. We got support. Let's call it 112,000. You break that, then we got a problem. We're probably going to head down a flush, and that's going to be a leading indicator again that the market will probably going to do the same and have a larger correction. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? Wednesday the 20th, we got a bunch of Fed zombies talking, so who gives a shit here? From Atlanta, Christopher Waller, probably all of them are kissing ass because they want to be me. Pick me, please, Mr. Trump. And he's not going to pick any of them, these losers. Anyways, let's go to the earnings calendar. We have a pulse on the consumer in TJ Maxx in the morning. That's going to be really important. The tariff impact, is the consumer shopping or not? The price sensitivity, that kind of stuff. You have Lowe's, which again, we're going to have a confirmation of what we got in Home Depot today with sales being down, with tariff risk. We'll see. You have Target. This is probably the most important one because Target is a pulse on the consumer that comes out in the morning. And then I believe after the bell, we have WSM Williams Sonoma. That's going to be a pulse on the affluent consumer. So we have plenty to look forward to. Let's take a rest right here, folks, and call it a day. Thank you for joining us tonight. If you found this video informative, return the favor, please, by subscribing to the channel, pressing the like button, leaving us a nice comment in the section below, and better yet, consider joining us as a Maverick member, following the links in the description on Patreon or YouTube. That way you get access to all of the bonus videos and the daily coverage that we do. You're not going to miss out on any videos. You got to do it for a small fee. It keeps us independent from YouTube. Anyhow, folks, once again, thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Would you two just shut the fuck up and let me enjoy the last hour of quiet I'm going to experience in the next 4 years?
Going round through my head, me so angry. Know that the flame still burns. Why can't I get over? When will I ever learn? Oh, love, leave me alone. Oh, love, go on home. I can see your face, but I know that it's not real. Just an illusion caused by how I used